Make sure it works. And just try and find what I'm looking for. I say the iLearn site now is fully populated with all of the material for the whole course now. So you have everything to hand. And I put quite a lot of material up on efficient markets and market efficiency for you to watch interviews with different people. Okay, different looking, especially like people like Warren Buffett and how he can outperform the market. And the tutorial questions are sort of split between things that were sort of relatively straightforward and then a few more advanced problems. So what we can do this morning is have a look through the tutorial questions and just to go through efficient market hypothesis and how it affects and how the markets should reflect accurately all the information that's available, and therefore we shouldn't be able to get these gains on the market because everybody should be aware of all the information. The market should be pricing the assets correctly. So we'll look at that first of all, and then we'll move on and look at property investment, which is a way that we can diversify investment portfolios. Okay, and we'll look at some of the risks with property investment and some of the challenges that are faced by it. And of course, this was one of the major changes in investment practice from the sort of the late 90s to the early noughties, was the investment and the move away from investing in shares of large blue chip companies where you were getting a fairly regular but low return, and then moving towards investing in real estate, as Americans would call it, where the gains were much higher. And ultimately, as I say, it sort of drove this investment in real estate, drove some of the financial crisis of 2007, 2008. It was one of the main reasons why Lehman Brothers went into administration, was their strategy investing very heavily in property in the US, which eventually it worked out it was worth nothing. It never actually got developed. So what I'll do, and I'll leave the chat bar open, so if you've got any comments, questions, or whatever, rather than shouting out or whatever, if you want to fire them into the chat message, the meeting chat, then we can go through them. But I'll bring up the first questions, which are on market efficiency, so a strong, weak, and semi-strong market efficiency, looking at the basis of which they're formed. So again, this is a recap of what we did last year. We touched on market efficiency just at the end of corporate finance last year. And then we'll go on and look at some more advanced questions, looking at how efficient markets can be viable, arguments against efficient markets, how people can book the trend with these efficient markets and take that advantage and get these gains that are above the market rate. Because remember, the market is always moving. Okay, so it's like house prices when we look at property. Okay, so if you watch whatever the property program that's on in the morning with Dion Dublin, okay, and they buy this property at auction, and then intrinsically it tends to go up in value as the market moves. So some of the gain in the property isn't made by the speculator at all in that property or what they've done to it. Okay, it's made by the movement in the market. So what we want to do is we want to strip out those moves in the market. And I think I put the podcasts up where David Hillier from Strathclyde University has actually done some empirical research on this. And he stripped out the market movement from movements within companies to show the effects of market efficiency. I think I put those podcasts up onto the iLearn site for you to watch. So what I'll do is we'll have a look at the questions, The solutions are all up there. Okay, and as I say, it's something we can looked at before. It's something that put plenty of material up for you. But if we'll just have a quick run through them before we have a look at property, because property is something a little bit more different that we haven't looked at before. So if I just share my screen with you now, and we can discuss these, and say anything that you don't get, just shout out, and you just work out how to share the screen. I've not had a class for a while, so there we go, screen 2. Oh, just before I do that, hold on, let me come back, let me stop sharing the screen again. Just to give you the heads up, I think I've got your exam dates. Okay, I haven't posted them because I've not got everybody's exam dates, but I think I've got yours, so just give me a second to find my email from Gonzalo. Okay, so you, for advanced corporate finance, which is a 2-hour exam, have I got a date for this? No, I'm sorry, I haven't got a date. I've just got a confirmation that it is a 2-hour exam. I thought I had the dates. I've got it on an email from registry at Abate, but it's not got the dates on it. It's just saying it's a 2-hour exam. So apologies for getting your hopes up there. So we'll go back to the tutorial. And you should see the question pop up here now. I say the way the tutorials are set out, the first ones are just sort of easier sort of quiz questions, and then the advanced problems. They're pretty much the same way that we did the tutorials in corporate finance last year. And when we're talking about, so the first question was asking you about the 3 types of market efficiency. So again, this is looking at what we'd done last year, where we have weak form market efficiency, where the markets are priced on past prices. We have semi-strong market efficiency, where we have all public information is taken into account when we're deriving the prices. And then we have strong form, where all private and all public information is taken into account. So we've got the 3 types: market efficiency: weak, semi-strong, and strong. And the basis for market efficiency is that these arbitrage opportunities exist. If they do exist, then individuals will take advantage of them. So this is an arbitrage opportunity, is the difference between the market price and the actual price, in which exists for a small period of time. Whereas individuals and investors with high wealth can take advantage of these small gains. And they would take advantage of that until it was no longer possible, because as soon as we start buying a product, the price goes up on supply and demand. And market efficiency assumes that there's only a small number of people that are going to be required to monitor the prices to ensure the efficient market takes place. Okay. So we had the 3 types, and this basis that the market will correct itself because of the economic principles. There are lots and lots of challenges to market efficiency, many of which are discussed in some of those podcasts that I put up for you and dug out for you. And if I find more interesting things to put up there, I will do. Unfortunately, you guys don't do dissertations anymore, because it used to be quite a good topic for a dissertation, was market efficiency, because it's something that you could actually do quite a lot of empirical analysis of. But I mean, there are a huge number of challenges. There's not just 3 challenges to market efficiency. You know, we've got things like conservatism, and representativism, which we'll look at slightly later on, where representativism, that happens in everyday life. We use a small part of the population to represent the whole population. And we can have that principle when we're looking at valuation of equity as well. We've got conservatism within the markets of where the assets are conservatively valued. We've got the bubble and the bust, so we've got boom and bust, and these, the economic cycle that flows through these things. We've got a large number of examples where assets are priced incorrectly. You see this quite a lot when you see new flotations of companies on stock markets where they either overestimated the value of the company or underestimated the value of the company and the trading on afterwards. So there is quite a number of challenges to market efficiency, but the real question is how big are these factors on the efficient market and how efficient the market is compared to these challenges that it represents. So just be aware of the three types of market efficiency and the challenges that they face. Then asks you about conservatism and representativism. So as I've said before, representativism or representativeness, easy for me to say, it's where we use a small sample to assess things. So we base our opinion on a small sample that we think represents the overall sample. So, the risk is that we haven't got that correct representation of the whole population. So we do this in everyday life through me looking at students or looking at things that we buy from service we get from one branch of a shop we take to be representative of every branch of a shop. So we don't go back to them, etc. Okay, so representativism is just looking at the way that we determine how we look at the whole population by a small sample. And conservatism is this idea that markets may take too long to bring in new information. Okay, conservative with a small c, so they're taking too long to justify amending the price of the equity due to that new information to ensure that the new information is correct. And it's an unwillingness to incorporate new information fully until it's certain that it should be included. And, we're all inherently conservative with a small c. And the example I used, I think, in the solution to this question is, if you think back to a year ago today, or a year ago last month when we were still doing audit, okay, unfortunately we'd got all of the audit lectures in, but who would have thought that, that a year ago we'd still be sat here. We didn't really build that into our approach in March, April last year. We were very conservative and unwilling to accept the new information that was on board. And then a year on, the whole of your fourth year has been done remotely, which we certainly didn't think would be the case, this time last year. So it's that idea of not wanting to fully incorporate information or knowledge until we have all the information and we can fully accept it, is the idea of conservatism. And markets tend to be can be quite conservative. Then come on, and we've got some look at prices and anomalies. So we have an investor follows director buying and selling. What is he intrinsically assuming? So what they're assuming is that the directors have asymmetric information. Okay, so they have information about the company that they are following. So we have to be careful. It should be directors rather than director. Okay, so we have to be careful, of course, when directors are buying, selling shares, and there are stock market rules on this, because of course directors can own shares in companies and enlist in companies. but what we need to make sure is that they're not acting upon insider information. And then if we have people that follow the investment of directors, they could be assuming that these directors of the company have this asymmetric information that isn't available to everybody else. And therefore, there's a violation of strong form market efficiency because the share price doesn't factor in all public and privately known information. And so these people will presumably think that asset prices will change over a period of time as the directors or as the information is released to the public. So if you think about all of these things that could be in place, such as mergers and acquisitions or disposals or release of financial information that a director of a company might be aware of, and obviously they need to be careful when they're trading shares in the companies that they're directors of, that they're following these stock market rules. We have then things like price to book anomalies, and this goes back to some of the empirical research that's been carried out. And a lot of that empirical research has found that generally companies that have high book values to compare to their share price tend to outperform growth stocks. So they outperform those that have low book values to their share price. So we're talking about the value of the company compared to the share price. So if it's a high value of the company and compared to its share price, it tends to outperform those the other way around. And I say there's three models that were produced, or a three-factor model that was produced in the 90s by a couple of guys, Farmer and French, and I think Farmer won the Nobel Prize for Economics back in the, I think not that long ago actually, relating to book price and price of the company to these share price anomalies. We then have this idea of boom and bust, which unfortunately you've not, but I've gone through quite a few booms and busts now, from the early 70s, 73, 74, to the late 70s, to the mid 80s, so the early 90s, and then the mid noughties, and now, now the sort of current government sort of shored up crisis that we have because of COVID. So you have a number of bubbles and crashes in markets, and it's a question of why these arise. You know, we have this economic cycle of boom and bust, which you will have looked at when you did economics. We also have this idea of behavioral finance, where people that believe in behavioral finance or market efficiency, okay, will lead to things that change the prices, and it leads to it acting like a wave where it just builds things up. If you think back to the financial crisis of 2007, which is probably the only one that you can remember, although some of you may not remember 2007, I'm forgetting it was 14 years ago. So, you know, in terms of those, it moved pretty much like a wave, okay? So we have that sort of general economic cycle that we've been through, certainly through several ups and downs. You know, in the 80s, we had huge highs followed by we had a huge but a period of decline in the early 80s, and then huge period of growth in the mid 80s, you know, where we had the sort of, if you remember the sort of Wall Street mentality from the film with Michael Douglas. And believers in market efficiency have a problem explaining these idea of boom or bust, you know, this economic cycle, because at all times of market efficiency, the price should reflect all the public and private information if we believe in strong form efficiency. So generally what they say is that the information changes, which causes the price to increase and the price to decline. So it is driven by information. So it is factored in, okay? But you would expect that there wouldn't be such a huge decline in the whole market as such when it's factored in gradually to each company. So this idea of the economic cycle of boom and bust is a difficult one for people that believe in market efficiency to explain, especially the sort of bubbles where the share prices are going up so quickly. And the final sort of quizzy question about the earnings surprise anomaly. So the earnings surprise anomaly, so a share with positive earnings, and if that is a surprise, it tends to continue to increase the price. Okay, so we have a positive earnings. It's a surprise that there is positive earnings, and then we increase the price for a number of months after that announcement is made, which tends to suggest that there is a lag time between that information becoming available and it being included within the price of the equity. So there is a suggestion that information is not priced immediately, which is therefore another weakness to market efficiency theory, which would suggest that it should be always reflect all information at the present time. So they're the sort of the basics which were covered in the lecture and in all of those different podcasts I put up. And maybe I hadn't recorded a lecture for the property one, but I will have a look today as well for some further sort of information on property for you. I said I didn't think it was worth looking at the lecture slides themselves are fairly self-explanatory. So it then moved on to questions that related to some of the podcasts. One of them was looking at Warren Buffett, Berkshire Hathaway, and how he tends to historically outperform the market. And because he's outperforming the market, it would suggest that market efficiency is not, not holding, as it were. So the first part is explaining what is meant by efficient market theory and discuss some of its implications for corporate financial management. So what we've got here is we're now into the sort of realms of sort of exam style questions. And what I'll do is I'll post the last exam paper up for you. In fact, if I give me a minute, I'll do that now, just so that we can have a chat about it. So just give me 1 second, let me find it. Right, and I'll just save this to the meeting chat at the moment, and I'll save it to the Island site and as a file as well. So just give me a second to download this. So I should be able to bring it up into the meeting chat. I say we can just have a chat about the format of the exam as well. So let me upload this from my computer. So I've attached that to the meeting chat. I'll just bring it up before we consider these questions, just so I can illustrate what I mean. Let me just, that's not the way I want to do it. If I just open this up and let me just drag it over to my other screen. It's on that window there. Now you should hopefully see the exam paper in front of you now. Okay, if not, you've got it there anyway. But the format of the exam, as before, you've got 2 hours for the exam, and you're required to do 2 questions, 1 from each section. The first section is the one that you've already practiced on with the mock exam I gave you, which is the numerical questions, which you'll see here. And the exam was fairly similar to the questions that I've given you. Okay, I wouldn't expect the actual exam in December to be, in May to be too dissimilar. So you've got an option between the main topics, which is using options, decision trees, and real options using the Black-Scholes model, or you've got a capital structure and short-term capital management question. So looking at Miller and Modigliani, and then looking at financial distress, and looking at cash management using either the Baumol or the Miller-Orr model. And you would do one of those questions. I would say that part is very similar to the mock exam I created for you before the holidays. The second part of the paper, where again you're required to do 2 questions, and again this comes from the sort of the more narrative parts, so you're only required to do 1 of these 2. And you have a question here on ethics, which is what we're going to look at next week. And then we have a copy of a question on equity and property, which again is something we're going to look at this morning. So what I'll do is, you've got a copy of that now. Okay, and in fact, once we do one of the tutorial questions, you'll see how that one becomes quite straightforward. There's nothing massively complicated in these calculations. I hadn't noticed that before I put the tutorial questions together. Okay, so have a look at those questions. If you want to start working through these questions, questions 1 and 2, as additional practice, please feel free to do that. Okay, and I'll write, I haven't got a solution yet. I create a solution, I'll handwrite a solution, and I can send that, or I can, you can check your answer against it by sending me your work. So please feel free to have a go at 1 and 2. But the exam, the format will be the same, 2 hours. So 2 questions, 1 from each section. There's no compulsory question. So it's 1 from the numerical and 1 from the narrative. You can therefore do, you can get 100% in the narrative question, in the numerical question, and it'll shore up any sort of issues you have with writing, if writing isn't your strong point. So that's the exam question. I'll just what I'll do is, I'll just give me a second. I'll add that to the iLearn site now. Yep, so you do the exam, I've frozen for a second there, it was a bit of a cough. Sorry, I've got. So yeah, the exam you'll handwrite, or I would suggest you handwrite the numerical question and you type the narrative question. Okay, and what I would do is I would just take a photograph of your numerical work and then cut and paste it into the Word document, and either send me 2 Word documents or cut and paste it into the same one. Just having the one document makes it easier on our systems, however, but the only thing is we can't use Excel. We got pulled up about that in December. We shouldn't have been using Excel for, just because it makes it a little too easy. With corporate finance, I say almost everybody handwrote it because of the formulas that are involved in this. So what I'll do is I'm just going to upload this. So just give me a couple of seconds to put this on to the island site, because otherwise I don't want to forget about it. So, I don't know how many more exam papers are, because this is a new module. So this may be the only exam paper that I have. I might not be able to give you the resit paper, because the resit paper, if nobody needed it, may be used for your exam paper. Okay, so this may be the only paper I have. And we're running slightly out of sync from Abate just because of the way we're structured. So this was actually done in January 2021. So everybody at Abate has done this module in semester 1, and we're doing it in semester 2. So that's the other reason I think I may not get a resit paper, because if nobody's had to resit in Abate, we will use that as a paper for you guys. So let me just. I'll do that as well, Samantha, right now, so that I've done it, and a reminder whilst I'm on the island site. If I do things whilst you ask me to, it makes it more sense. So that past paper will now appear on the island site. I say if you want to attempt those, what I'll try and do, I won't have time this week, but I'll do solutions for the numerical part sooner rather than later. Okay, I may get them done tomorrow, but I'll let you know once I've done them. Let me just create an submission inbox. What I'll do is, for the submission link for your report, I'll create you can submit 2 files, one if you have an Excel file with any workings, and one for a Word file with your report. Unless you've incorporated your Excel files into your Word document, which I sometimes find tricky to do. So I'll create it so that you can submit 2 files. And just a reminder on the coursework, it is due on the 5th of May at 23:59. 23:59 shouldn't be a target. So I'll just do that now. Give it a second. Okay, so on the Island site now, you'll see that previous exam paper. I put it right at the top of the page, and I've created a coursework submission inbox in the coursework tab, where you can submit, and you'll be able to submit 2 files. I've called one the report and one Excel models, so you don't need to waste time trying to create one document. Okay, so you can submit your report and refer to the appendices, and the appendices you can upload it into the Excel file that's attached to it. Just maybe makes a little bit more, it makes it a little easier rather than trying to incorporate these Excel sheets into your written document. So you should be able to submit now if you're ready to submit. Okay, and as I say, you have until the 5th, so you've got another couple of weeks to do that. So that's all that done. As I say, I'm better doing these things now whilst I remember you. So if we go back to looking at the market efficiency, we'll have a look at these questions. And as I say, these are more sort of exam style questions. So I'll share those ones with you. And it's the same with our tutorial on property. Okay, it's the same idea. So the first part is explaining what is meant by efficient market theory and look at some of its implications for corporate financial management. So what if an efficient market is where all information is immediately priced into the market. That's what we mean by efficient market theory. Well, what it does mean is, it doesn't mean that the market has perfect foresight of what's going to happen, but it does mean that the probabilities of outcomes change, so the price changes. So when things become more or less probable, the price changes accordingly. So there is a degree of probability in there. So this is what we looked at again. Remember when we looked at valuation of when we looked at portfolio theory and expected returns, and how we were looking at the standard deviation as a measure of the volatility of the return. Okay, so it has got implications for corporate financial management. And the quote here is, even in an efficient market, it's still valid to seek out a favorable rate of return from an equity investment. Okay, and this comes from one of the podcasts, the articles we put on in the efficacy of dart throwing. Okay, so as we saw in one of the previous sort of the quiz questions, I think it's the last one, the earnings surprise anomaly, there may be a delay or a slow response or an overreaction of the market to new information, okay, which isn't consistent with market efficiency, that over or under reaction. So what we could have as well is that someone with inside information can make abnormal returns, so returns out with the market trends. But in this efficient market, prices should have absorbed all of the available information for every share, and no one should be able to consistently earn abnormal returns by trading on specific shares in comparison to any other random share. Okay, so that's sort of efficacy of dart throwing. You know, just throw a dart to pick a share and you should make a return. And this comes very much along to this idea of you know, having a well diversified portfolio of shares. And again, if you read the article or watch the podcast relating to the efficacy of dart throwing and how we make abnormal returns and how to make abnormal returns on a ongoing basis, not just on a one-off basis. And if I say what you've got to factor in is you've got to factor in the fact that the market moves. So what we've got to look at, and if you look at the podcast from David Hillier, what he looks at is the sort of, it strips out the market movement to get abnormal movements in share prices to try and see if there is a trend in these share prices. So yes, people seek out that favorable rate of return from their equity investment, but given that strong form market efficiency should hold and all public and private information is factored in, then the market should reflect accurately everything at that time. And to say, although there may be a slow response to some of these things, so unless you have access to insider information, abnormal returns are not the norm. Okay, because of that. So it doesn't really matter what you invest in, you should be getting, the market should accurately reflect that. And then you've got this idea of behavioral finance, which we talked about in terms of management and investors last year. And we talked about something called hubris, where investors believe that they can make up for losses and gains. And behavioral finance, which is a whole scope, I know some of you may be going on to look at doing a master's and things like that, where, you know, behavioral finance is it'd be something you maybe come across a bit more detail. What it shows is that at times markets can be inefficient because behavioral finance would suggest that things are done by humans, where we make decisions based on irrational information and which may be not factored into an efficient market. So if we accept that markets can be inefficient, then it opens up this idea of financial engineering to create value. It also suggests that prices of shares may remain below what they should be, and they could be valued at a lower price for a prolonged period of time. But I say what we've got to consider is that people investing in markets can drive share prices as well. So there is a human element in the pricing of these things. So it may not all be related to the information that's available. So if you've had a bet on the Grand National last week, okay, my horse, I think, is still running. Okay, you maybe didn't. How did you pick your horse? If you picked a horse, you maybe picked it on a name, okay, which is irrational, isn't it? Picking a horse, which is an investment on its name. You know, you wouldn't invest in a share because you like the name of the share. So you maybe didn't even look at the odds of the horse, which are its chances of winning. So if you're looking at a share, you'd be looking at the previous returns as what you can expect. Effectively, that's the same as the odds on a horse, but we've picked it by the name. So because more people pick the horse by its name, that drives the odds down, which makes it look more favorable than it really is. And that's driven by human behavior, and human behavior does come into investment, and it does come into markets, and it is a flaw in market efficiency. And the final one was looking at Warren Buffett's video, where it's an interview there with Charlie Munger, I think it is, and looking at the returns that Warren Buffett and Berkshire Hathaway have made, which is quite difficult to explain. I think the interview goes for about 35-40 minutes. It's quite interesting, quite good to watch. And you know, it was always explained, if you think about statistics and we think about, you know, an average, okay, and we think about how investment funds have grown, we would have an average growth. And Warren Buffett and Berkshire Hathaway were always deemed to be an outlier. So that's just some random statistic point which we can't really explain. You know, we just don't take it into account. But it's not really an outlier because he's been persistently and consistently successful at outperforming markets. And other people that have studied and um, worked with following sort of Warren Buffett have also been successful. And what it really does, the success of Berkshire Hathaway really does sort of question whether um, efficient markets theory does hold. You know, if we don't treat the performance of some of these high performing funds as being outliers, then it would suggest that they are outperforming the market. And if they're outperforming the market, therefore efficient markets don't hold. So obviously now Warren Buffett has got to such a stage where he's the second wealthiest man in the world that he often does get offered sort of sweetheart deals whenever companies require refinancing. Um, but as I say, if you watch that YouTube video, I mean, the returns that he makes are fairly remarkable. It's quite staggering the amount that they're making there. And I say I can't remember if I've put a link up there. On the solution, there's a link to an Investopedia article relating to this. Let me just check and see if I've got that on the iLearn site. Maybe not, but it is on the bottom of the solution. So just have a click through and follow that. So that's market efficiency. As say something we looked at last week. If you can hear what sounds like somebody drilling, it is because I've got builders in the back garden at the moment building. So if you hear lots of building type noises, that's unfortunately me. It's not your connection. So what we'll do is, why don't we take a 15-minute break, and we'll come back at 25 to 11. And then what we'll do is we'll have a look at property investments and how we can use property and we can use property as part of our portfolio of investments and how we can look at some of the challenges with property. So if we take 15 minutes, we'll come back at 25 to, and then we'll move on to that. So I'll see you all back online in 15 minutes. Okay, so we'll bash on with the second part of this morning, and we'll look at our property and how we can use property within. So I just got pinged there by a message from Robert. So how we can use property as an investment asset. And I've put the slides up on real estate and property investment. And I'd put a couple of articles up there on using real estate as part of a mixed portfolio and looking at UK property investment. And if I bring the tutorials questions up, we can have a run through these. And again, these are on similar sort of format. And without knowing, say, if you look at some of the harder questions, they look similar to those ones in the last exam. So I'll just bring the question up. So, and I'll share the screen with you so you can see it, although you'll have it at home as well. So let me just bring up screen 2. And I'll bring you back on here in case you've got anything to fire into the chat. So in here, again, we've got the sort of easier quiz type questions, sort of the starter. And you know, you probably could have answered these without having read anything of the lectures or some of the associated documents. But in terms of the main types of commercial property, the traditional types, we have, you know, in the UK, we have things like the office sector, and these are things that are coming under, you know, a great deal of pressure post-COVID. You will have read in the news about people no longer thinking about or working from home and no longer traveling into work. So therefore, it has an impact on the valuation of commercial property. So we've got that office sector, you know, which is predominantly city-based. If you think of the City of London, and when you've watched the start of the Apprentice or something where they fly in over the MBNA building and things like that. We then have the sort of the retail sector. So if you think about in Kirkcaldy, you have shopping centres like the Market, although there's not much in there at the moment, or you have these out-of-town retail parks. And then in terms of other commercial property, you have that sort of industrial warehouse type sector, which is, you know, where you see these larger out-of-town developments, you know, logistics centres. If you think of driving through Pitreavie and looking at all of the sort of the buildings that used to, well, the Sky Building is still there, but you think about all of the sort of the engineering places that are out there. So they're the three main types, but in recent times, a lot has been moved towards other types of commercial property, things like student halls of residence. And there are now companies that own student halls of residences, which is different from my day. The universities owned the halls of residences. But now what seems to have happened is they've moved and they're now owned by third-party companies. Okay, and the facilities have changed, and the price has changed as well. Gosh, I was I think £900 a year for my accommodation at university, and my daughter was £5,000 a year. So there obviously is an inflation factor there because of the difference in timing. I was 1989 compared to 2019, but you know, it's even though it was 30 years, it's still quite a difference. So you've got different sectors in those commercial properties, and people like, why do they want to have this mixed asset portfolio, and why are they going to invest in the real estate or property? Well, they have that diversification of risk. It reduces the risk, so they have a sort of benefit from diversification. And other aspects are that, you know, it's a tangible asset, and people tend to like tangible assets because they can see them. Okay, they can touch them. Okay, and it's physical. It's like land, isn't it? Land is another type of property, if you like, that can be held, and it has that physical value, physical presence to it. And in terms of property as being different, I say it is a physical asset, and we know that about physical assets, tangible, non-current assets. One of the things that we have to be careful of with property is that it is maintained, because property deteriorates over time. So we need to make sure that to maintain its value, that we have maintenance and upkeeping of that, and even renovation. You know, if you think about office property, you know, the office of 20, 30 years ago compared to the office of today. Well, the office of today, as you can see, is my home, but the office that you work in now maybe will look completely different to how it looked 30, 40 years ago. So we need to make sure that it's renovated and kept modern and up to date. So that makes it different from other investment classes, is we don't have that maintenance required with, you know, bonds or equity. In terms of how we can add value with property, so what we can do is we can change the physical format of the property, so we can add value to it, we can extend, we can increase the value, we can change the layout. And if you think about sort of City of London offices, you know, if you've ever seen inside the Google offices in London, or some of these IT companies that are very bespoke, you know, these are regularly refurbished, and these companies pay a huge amount for office space. Office space usually is rented on a value per square foot. And I don't know what it is currently in the City of London, but certainly in Edinburgh, the last time I checked, you're about £2,500 per square foot. So it's quite expensive. So they need to be regularly renovated to justify that cost, and to maybe justify an increase of cost. You can add extra facilities in there. You can increase you can increase the value of the property with those facilities. So then we moved on looking at unit trusts. And a unit trust uses a survey to value the property in the fund. Okay, and the problem is that valuing a property is fairly difficult, and it's difficult to find a like-for-like basis for a commercial property. So if we're looking at how the price of a top-class office in Aberdeen has changed over the past 3 months, it's difficult to assess because there's not many ones that you can have an effective comparison with to come up with that price. Say it's a lot easier to look at residential property and see how they're moving, because there's a much bigger market in residential property. So if you were to look at, you know, one of the online estate agencies, or if you look at Zoopla, you know, to see how much your houses in your street are selling for if you own a house. Okay, something you look at is, do you look at how much the neighbours, when the neighbour's house comes up for sale, you look at how much they get for it. So it's a lot easier to get a comparative with residential property. You know, it's not necessarily as easy with commercial property, you know, in terms of calculating that unit value. And if you were to think of, say, the Mercat in Kirkcaldy, you know, we haven't really got a comparison in Kirkcaldy to value that, but then you may be able to value that with the Kingdom Centre in Dunfermline, or what is it called? It's Kingdom Centre in Glenrothes, and whatever the one in Kingsgate is it in Dunfermline. So it's more difficult, but it would use a survey to find that value. And in terms of the value that's created from that, the stock market tends to match sales, and hence price can trade well below that actual value, the net actual value. And it's something that's not particularly prevalent in the UK, because in the UK we don't tend to have, sorry, I've just clicked, there we go. In the UK we don't tend to have very much sort of very large residential property companies in the UK. Because in the UK it's quite unusual compared to a lot of other places in the UK, in that we won't have, most of us want to own our own property. Okay, and we own up, we don't have a lot of rented property, and the property that is rented tends to be owned centrally by central government, as opposed to being owned by large individual letting agencies. So we have those agencies, but they tend to deal with a large number of smaller individuals. So the largest one in the UK is a company called Granger PLC, which is possibly, I think it's still the largest residential property company. And it was also, we had, I say, a huge amount of property that was owned by local government and rented out by local government. If you were to go and look in Europe or in the US, it's completely different. Where you have a large amount of, if you think of, you're watching some of these American programs, they're always talking about condominiums or condos, where you've got 300-400 houses that are all rented from one company, and they manage a single complex. It can be similar in sort of parts of Europe as well. In terms of rent controls, traditionally in the UK, we've had rent control to try and make housing affordable. The problem is with rent control, we always have this problem with landlords who then don't maintain the property. If you watch some of these horror programs on, landlords and things you see on the TV where the property hasn't been maintained. And obviously over a longer period of time, that would record to degradation of the housing stock. So rent control has got issues. The idea is that the rent should be fair, and then the property should be maintained. And if you look at current rental agreements, that's very much what it's based around. Because that poor state of repair has a negative impact on the tenants. The rental control is is therefore there to try and prevent damage to. So rental controls are quite a sort of a moot point on the benefits of them. We treat rental income as being a perpetuity. Okay, so if property has a rent of £1,000 and it has a yield of 4.5%, calculate the purchase price. We treat it like we're calculating the value of a perpetuity. So we do 1,000 divided by 4.5%. So this property would be worth £22,000, £22,200. So you just divide the 1,000 by 4.5% to get the value. So the rental income is treated like that perpetuity. And as I said to you before, generally rent is valued on a square footage or a square meterage basis. So what we have is, in this question, we've got a property that achieves £90 a square foot and is 25,000 square feet. What's the annual rent? So it's just the 25,000 times the £90. So the annual rent would be 2.25 million for the property. And I'll see if I can find out what the average rent is in Edinburgh. It might, depending on what sort of property you have, it can be. On Princes Street it was quite high. There's nothing coming up straight away. I'll see if I can find something on what current rates are within local areas for commercial rent. But I think it used to be about £2,500 a square metre in George Street or in Princess Street in Edinburgh. So those were the basic questions, and then we come on to some calculations. And again, if you look to question 2 in the exam paper I've just put up for you, you'll see a question relating to a company's beta and calculations of beta. So beta is a measure of risk against the market. It's the same principles as the capital asset pricing model and the calculating of the expected return on an asset. So it's exactly the same theory, apart from the expected return on this asset. It's not an intangible, it's not an equity, it's actually a tangible asset in terms of a building. So what we'll do is I'll add solutions in here. I'll just add them into the Word document. Okay, so we can see them. I'll probably mess up all the formatting as I try and do this. I would normally try and do it in Excel. So we have a property has a beta of 0.9%, 0.9. So if we accept that 1 is a property with a beta of 1 has the same overall risk as the market. So if it's less than 1, then it has less risk than the market. So this property is 0.9, so it's less risk than the market. The risk-free rate is 8%. And the risk-free rate is usually determined by a measure to a government bond or something like that. And we have the risk premium. So the risk premium is the difference between the risk-free rate and the market risk. And it says calculate the required rate of return. We've got the so we've got a beta of 0.9. Let's highlight the key things in this question. Risk-free rate is 8%, and risk premium is 5%. Now, if you remember back to the capital asset pricing model, this is the key thing in here. I'll go through the formulas with you. And we have rental income of £100 per square foot, and we have that the office is 250 square foot, which isn't particularly big. It's quite a small office. So if we think about our capital asset pricing model, okay, so if we think of what CAPM is, and if I do this, I'll do this in a different color so it stands out a little bit. It may be different to the tutorial, the way that it's presented on the solution, but it shouldn't be too different. I'll do it in blue. So the capital asset pricing model is where we had the expected return from our asset is equal to the risk-free rate plus, and I'm not going to do a beta, but I'll do a capital B to stand for beta. And then we have the market. Oh, okay. Oh gosh, don't know what's gone wrong there. Everything seems to go black. We have the beta multiplied by the market risk minus the risk-free rate. And remember, this part in here, this part here is the risk premium. Okay, so that part there, if I can draw this in, that there is the risk premium. I'll just call it risk prem because it's going to take me forever to write it there. That's the risk premium. Okay. So we can work out what the expected return on this asset is. Okay, so if I come back, take my pen off, come back here, and we want to know what our expected return is. The risk-free rate is 8%, so we can do 8%, or you could do it as 0.08 and then just convert it at the end. It doesn't make a difference. Plus the beta of this is 0.9, and the risk premium is 0.5. 5%, so 5%, there we go. So remember, when you're calculating the capital asset pricing model, do this thing first. So it's 0.9 times 5, which is going to be 4.5 plus 8. So the return required is 12.5%. So that's our expected return that we require given the market return on this asset and the risks in the market. Our rental income, again, that's relatively straightforward. Our relative rental income is going to be 250 square foot multiplied by the income, which is £100 per square foot. So that's going to be £25,000 per annum rental income. And therefore, to work out the cost of the property, we can treat this as a perpetuity. And where the expected return equals the yield, the annual yield. Sorry, it keeps changing that. So for the cost of our property, what we're going to do is we're going to take the rent, which we're going to get every year, £25,000, divide it by the 12.5%, and that will give us the value of the property, 25,000 divided by 0.125, which is £200,000. So that's that one done. And it's very much treating it, what return are we getting, what the value of the property is, and what the rental income is. And if you after this morning, if you go back and have a look at that second question from the previous year's paper, you'll see one of the questions which relates to this. So we then have a change in it. So what I'm going to do is I'm just going to push this down a little bit and create a bit more space to add things in here. Okay. And again, let me just change the color. And what I'll do is I'll just save this and upload it to the island for you. Okay. But what we've got is that in terms of the equity, it says, imagine that the property will be financed with debt making up 75% of the capital structure. Calculate the beta and the required rate of return for the property. So I think in the previous year's exam, let me just check if it gives you a formula for this. I've now got loaded. Just give me 1 second whilst I try and find this. Quickest place to find it will be clicking on the island site. Now, it doesn't give you a formula for this part in here. Okay, so what's given the table below for calculate the equity betas. Okay, so I'll give you the formula in here, and then you'll just need to remember to take a note of it for your own. So the beta equity, so the equity beta, let me just put this in here, equity beta equals the asset beta multiplied by 1 plus the debt to equity ratio, debt to equity, like that. Okay, so again, I think that's in the formula sheet that you've got as well. Okay, and So it's saying that in this question, imagine the property will finance the debt making up 75% of the capital structure. So again, don't get panicky about the fact that there's no numbers in there. If there's 75% debt, there must be 25% equity. Okay, so again, it's relating to this company above here. We've got the beta for the property is 0.9. Okay. So we can now calculate the equity beta. So this is the risk of having money, the risk of having equity in this property. So we have the asset beta, not bets, asset beta at 0.9 multiplied by 1 plus the debt to equity. So the debt to equity is 75 to 25. Okay, so it's just the ratio there. So what we're going to have is 1 plus 3 times 0.9, which is going to equal 3.6. Okay, so 3.6 is the risk of having the money in there. And if we're taking on so much debt, so we've got 75% debt to 25% equity, then the return required by the equity holders is going to be much higher because of the risks associated with that. So they're going to require much higher return, which is represented by this equity beta. If we then want to work out what the required rate of return is on the property, okay, so for the equity holders, we use the same idea as above here. So I can just copy this down. Hopefully it doesn't too much down with this. So I just put in here that this is the equity beta. So we're using the same idea here. We've got the risk-free rate remains to be 8.8%, but we now have an equity beta of 3.6. Then the required rate of return for the equity holders comes in at 3.6 by 5, which is 18 plus 8 is 26%. Okay. So if you look at the difference that we have in the returns that are required here, this one, where we use debt to finance it, and the return that's required by the equity holders there compared to this one here, then it shows that because of the introduction of debt, the equity holders require much greater rates of return. So let me just make some more space under here. So we have then, if the cost of debt is 10%, tax rate is 30%, what's the weighted average cost of capital, assuming a tax rate of 30%? So if we've got 75% equity, 70 and 25% debt, we can hopefully remember our formula for calculating the WACC. If we don't, I'll put it back in. Let me just change the font. So our weighted average cost of capital is going to be the debt over the valuation times by the cost of debt, or the rate of return that's required for the debt. So I'll call it RD. Okay, and then we've got to remember that's going to be multiplied by 1 minus the tax charge. Tax charge is 30%, and then we're going to add to that the equity over the valuation multiplied by the cost of equity, or the required rate of return for equity, RE. Okay, so D is debt, V is the valuation of property, RD is the rate of return required by the debt, TC is the tax charge, E is the equity, V is the valuation of the property, RE is the rate of return required by the equity holders. So our weighted average cost of capital is going to be 75%, 75 over 100, so 0.75 is the debt's evaluation, times the cost of debt, which it tells us here. Cost of debt is 10%, so we're going to multiply that by 10%, multiplied by 1 minus the tax charge. It tells us here the tax charge is 30%. So 0.30. And then we're going to add to that the equity. Well, the equity is going to be 0.25, okay, because it's 25 over 100. And then we multiply it by the cost required by equity holders, which is 26%. So 0.26. So we could work out weighted average cost of capital. I can't do this one as easily in my head. So it's 0.75 times 0.7 plus 0.25 is equal to 0.1175. Try using a 0 rather than an O, or 11.75%. So when you look back at, I think I've still got it here, have I? Let me just see if it's on here. So in this question, I say when you get down to part E, the last part of this, it's saying, given the table below, calculate the equity betas, assuming a 75-25% split. Okay, so we can have a look at doing that. We then have our company, really should be able to do that now using this part in here. Let me just bold that and I'll put it in a box so you know where to look. There you go. There could be no ambiguity about where to look for the formula now. It then says our company has recognized a way to add value to the property by increasing the effective floor space by 25%, but it will mean forgoing rent for a year and getting the extra 25% of rent income thereafter. Assuming the property will trade at a yield or cap rate of 6% and rent is £100 per square foot for 200,000 square foot initially, calculate whether the investment is advantageous or not. So we've got a couple of scenarios. We can work out what the rent is. I'll add a few more spaces in here. Just change the color so that it's different. So the rent is going to be the £100 times 2,000 square foot times the £100 per square foot. So that's going to be £200,000 per annum. And there we go. So then what we can do is we can look at our two scenarios. Okay, so first scenario is that we don't do anything. Okay, and I've got one less zero in there, and we don't reorganize and add value to the property. So it tells us that the current yield is 6%, so we can work out what the value of the property is in scenario one. So scenario one, do nothing. Okay. And remember, we're going to treat it as a perpetuity. So we have £200,000 divided by the yield, which is 6%. Which means that the valuation of our property is going to be £200,000 is going to be £3,333,000. It's going to be the value of the property. So that's our first scenario. Let's put them on. Scenario 2 is we reckon that we can add value and defer rent for 1 year. Okay, so what we've got to think about now is we're going to get a higher rent. So this will be a higher rent, but it's going to be deferred for a year. So we've also got to take into account the time value of money here. Okay, so we've got scenario 1. Just bold that. Scenario 2. Bold that. So we've got our £200,000, which is going to increase by 25%. So the rental income is going to be £200,000 plus 5%. So that's going to be now £250,000. However, we're now going to only get that in a year's time. So if we discount for a year, so we're going to get £250,000, and we're going to discount it at 25%. So discount it at 1 plus, because that's the extra rent that we're getting. Okay, so that's the yield, that's the rate of return that's required in this question. So that will give us back the £200,000. And then if we do the same, it's going to be the same valuation. So there is no difference between the scenarios in terms of the rental income. So historically, property companies fail because of development or lack of development or high debt. And I say the two of those can produce explosive returns, but they can also, as with most things, the higher the risk, the higher the reward, the higher the risk. They can also set up the stage for bankruptcy as well. And every recession, it tends to be property companies that fail, okay, because they've either invested too heavily and deferred rent into the future, so they run out of cash. Okay, so there is no advantage to deferring your rent for a year and expanding toward more income. Gosh, I didn't realize there were so many questions here. Try and get through them as quickly as possible. The next one we have, at the end of 10 years, the building is obsolete and no tenants can be found willing to pay the rent for the property. If the cost to knock it down is £100,000 and develop a new office is £400,000. So we've got two potential outgoings there of cash. And during the construction phase, the property will have a discount rate of 25%. After 2 years, the company expects to let out 5,000 square foot at £130 per square foot. Assume a yield of 6.5%. And then what happens if, when completed, rental is £100 per square foot and the yield is 7%? So we've got a couple of scenarios in here. So in this first one, we've got this cost in here. So we've got the cost to knock it down, so of 100,000, and we've got a cost to develop a new office is 400,000. We've got a discount rate of 25%. After 2 years, so we've got time in there, we can expect to let out 5,000 square feet at £130 per square foot. Assume a yield of 6.5%. So again, we've got a couple of scenarios. So I'll do them in scenario. Let's scenario 1. And in scenario 1, our rental income is going to be the 5,000 square foot multiplied by the £130 per square foot. So that's £650,000 per annum. That doesn't look right. Right, so we've got So we've got 5,000 square feet at £130 per square feet. That is, yeah, £650,000. So that's our first rental income. We've then got the price of the property. Which is going to be a measure of the rental income per year of £650,000 divided by the yield that is required of 6.5%. So divided by 0.065, which is the yield. So that comes out at 10 million. That's the price of our property. So that's our first scenario. And then we can work out what the present value of all of this was, because we've got to knock down the property and then we've got to spend money developing it. Okay, so in terms of the cash flows, we've got £100,000 to knock it down. We've got £400,000 to redevelop it. And then we've got this cash flow, which will be the price of the property, 10 million, but that's not going to be achieved for 2 years. So I'm going to discount that times 1.25, and that will be to the power of 2, it'll be squared. So we discount the cash flows going into the future. Okay. Now, I think I'm not, yeah, I think let me just 500,000, so 10 times 1. That should be divided, because it's not a future value, it's a present value, divided by 1.25 squared. So the future value, is that right? Have I done that right? £1 million, 10 million, 1, 2, 3, 1, 2, 3, divided by 1.25 squared. So £6.4 million minus 500,000. So it's 5,900,000. 900,000 in scenario 1. So let's highlight that. Then we have scenario 2, which is where we get £100 rental income per square foot and the yield is 7% when the building is completed. So scenario 2. Let me just, I can just copy this down, hopefully. The rental income is still 5,000 square foot, but it's now down to £100 per square foot. I've just realised I'm out by a factor of 10 up here. No, I'm not. That's right. No, I'm right. So we've got 500,000. So 500,000 times 50,000 times 100 is £500,000 of rent. I'm getting myself confused. All these zeros. Okay. So the price of the property now at a 7% yield. I'll just change these. So divided by 0.7 is 7 point is a funny number, 7,142,857 thereabouts, and therefore we can substitute that into here. So I'll do that. 7,142,857. Let me come up with a new answer. Divided by 1.25 squared minus 500,000. So the value of the property is just over 4 million. 0.71429. So as we change the amount of rental income, even though we're increasing the yield, okay, we're also decreasing the net present value of these properties. So what we've got to be careful with when we're looking at redevelopment costs into the future, and when we're looking at the rental that's being charged, we've got to take into account the net present value of these things. Okay. So bear in mind that these cash flows are in the future. The key message for that one. We've now got a final numerical one, I think. It says, assume you buy a property which rents at £120 per square foot. It's 5,000 square foot. So we've got that. It's got a yield of 5%. And you then immediately sell the property and it achieves a yield of 6%. How much money have you made or lost? Okay, so the first thing we can do is we can work out what the annual rent is. So the annual rent is going to be 5,000 square foot multiplied by £120 per square foot. 5,000 times 120, £600,000. And then we can work out, let me just change the color of this so you've got it. We can then work out, based on it's a perpetuity, we can work out what the initial price is. So the initial price equals £600,000 divided by the yield of the property initially, which is 5%, so 0.05, which makes it worth 12 million. If we then work out the price where it says you immediately sell the property and it achieves a yield of 6%, how much money have you made or lost? Okay, so sales price, £1,000 divided by 6%. So £600,000 divided by 6%, which is £10 million, which means we've lost £2 million on the transaction. So we've lost £2 million because of the change in the yields. So a loss of £2 million has occurred because of the change in the yield. So as the amount that yield goes up, the value of the property comes down. So the final ones, again, are looking at the efficiency of property markets. And again, there's a couple of documents I've put onto the Island site for you. And it says, if Evans would argue that property is less efficient than the stock market, what is his justification? Well, Evans is looking at, his argument is that property is a collection of location, size, and historical changes to property, so that every property is therefore unique. And even if we were to have two identical houses, so for example, my house is identical to the house next door to me, the value of those houses isn't the same, because even though they started off identically, over time, their uniqueness would increase. I think that's the right way of putting it. Okay. And as I say, over time, the valuation would slowly drift apart because of the uniqueness factor in these properties. And the uniqueness results in the price being difficult to gauge without that wide distribution. So if you were to look at all the property prices on the street where you live, they would all have different prices, even though they may all be identical properties. And it says, if property is inefficient, who gains or loses from this? Well, the people that gain from the inefficiency in the market are the people that have the knowledge about property. Okay, so not necessarily the people that are on Homes Under the Hammer. I've now remembered the program, you know, where they may be fooled into thinking they've made a gain because the market has moved. So it's people with knowledge gain, whereas those outsiders generally lose money, even though they think the value of the property has gone up. The value of the property may have gone up not because of the renovations that they've done, but just because the movement in the market has gone up. So they can be fooled into thinking they're making gains, but in fact they're actually losing money. And then it says, evaluate why empty land is a real life option. So empty land, because you can build anything on empty land, subject to planning permission, of course. And there are green site and brown site regulations now about what you can do and what you can do with property. Okay, but vacant property is a real option because you can develop it, you can build whatever you want on that, subject to planning permission. And I say, if you were thinking of, you know, I play golf. Okay, so if it's a golf club, and depending on if we could sell the land for the golf club and make substantially more profit than we have playing golf on it, then it might be an option that we need to think. But you've got to think about redevelopment of a new course, etc., for you to play on. But certainly a number of golf clubs have sold areas of land in order to generate profit, so it always has that value. Okay. So let me just save this so that and I'll upload file, save as. Again. And what I'll do is I'll upload that to the meeting chat as well. There is a solution on the Island site already. Okay. So that's just got the solution to the numerical questions. So that's both of the tutorials looked at, quite a lot to get through there. I don't know what's going on with my Microsoft Teams. It's something odd's happened. Right. Okay, it seems to be back. So that's the property part. I say what you could have a look at now is, I say question 4 in the paper that I've just put up for you deals with equity and property betas. Okay, and I say there's a rather large calculation, or you get quite a lot of the calculations. You get 50% of that marks for that question for calculating equity betas and then changing them. Okay, so you could have a look at that, and the first part is a theoretical question which should be covered in the notes to the lectures and the notes that I've put up there. So what I'll do is I'll stop the recording so I can post that to the tutorial channel. So let's stop that recording.